Hey fam, welcome back. So today we're going to be going over both portfolios and we're going to do an in-depth review. So with that being said, let's get it. Okay, so we will talk about Grayscale, but we're going to do that tomorrow because it makes sense. The markets are open tomorrow. Get a better estimate of what this whole downgrade on Moody's thing is going to be like. You guys can see that the market's just open and we actually did have a gap down. That doesn't necessarily really mean anything. But generally speaking, when you do get a gap down, the markets usually continue to push downwards, and the inverse is also true. When you get a gap up, the markets, generally speaking, do continue to push higher. So, but it's possible maybe this thing could just sell off during the open and also the midnight session. For those of you guys that, or it's better known as the Europe session. For those of you guys that actually trade futures, you know what I'm talking about. And then we could get an immediate reversal and go back up at the open itself. So, yeah, there's that. So anyways, let's talk about the portfolios. Just wanted to show you guys this. We did actually used to have a very large, diversified, basically dividend growth portfolio here. All these names, we actually used to own all of these. The list goes on and on and on and on. So if you guys think we're not aware of, how to, people call it proper investing because it's dividend growth, right? We've done it before. We've been in this situation. Okay. So it's really nothing new for us. But anyways, let's take a look at the current piece of this portfolio and go over kind of what the expectations are and why we're doing what we're doing. Okay, so it's taking a little while. There we go. All right, so we have these two main positions here, okay? We've told you before that the passive income positions that we want to hold a little bit longer term is going to be GPIC, GPIX, JEPQ, Triple QI, IWMI, SCHD, ACP, PDI, BSTZ, XDTE, AIPI, and SPYT. So basically, the vast majority of these decisions are these positions that we have. They give us broad exposure to the markets. Because again, until the Fed does cut, there is some kind of level of uncertainty, and they have already cut already, but they haven't really cut yet, right? And the markets are kind of flip-flopping on when they think they're going to do that. Maybe it's June, maybe it's July, maybe September. Nobody knows, right? I do, in my personal opinion, I do think the whole tariff thing is meant to kind of kill inflation enough to get it to drop to force the Fed's hand to cut rates. I told you guys this before. Do I think the markets are going to dump off a cliff and we're going to go into a recession? Probably not, because again, the Trump administration just locked in $3 trillion in business deals with the Middle East. I'm not going to go into finite details there, but there's that, and the tariffs and bringing in all the tariff revenues, and inflation's dropping, and the labor market's holding strong, and go on and on and on about this, right? So just to answer that question, but anyways, so PDI and ACP, we plan on holding these two. If we see another cut from ACP, we're probably going to get out of that one and replace it with something else. So we have all these other positions. We have RA, RYLD, GSBD, TWO, USOI, TLTW. And that pretty much sums up the larger piece of the portfolio there. So we do intend to get out of these, at least in the immediate short term, when they are at a profit. Okay, they're not at a profit yet. When they're at least break even or above, we plan on getting out of those, keeping these two right now at least at 30 all the way up to $100 a month. Then when we get the 12 positions fully laid out, we'll add more to it, meaning more positions. We'll maybe scale up to like 15 or 20 or something like that. But we need to at least get those to where we want them to be, which is all the way up to $100 a month a piece. Okay, so that covers M1 Finance. So we'll go over the Robinhood portfolio real quick. So we have all the positions that we've already told you about: SPYT, AIPI, XDTE, GPIC, GPIX. Let's see here, Triple QI, SCHD, JEPQ, and IWMI. Now, the only ones we have not loaded up on yet is BSTZ, IWMI, or sorry, not IWMI, GPIX, that's what I meant to say, and SCHD. The reasons why we have not loaded up on these yet is because we're still trying to top out PDI and ACP. So GPIC, JEPQ, Triple QI, those all give us NASDAQ exposure. GPIX and SPYT and XTTE is the S&P 500. IWMI is the Russell, and then SCHD is basically the Dow Jones. That's pretty much everything in the indices that we could possibly get exposure to, right? And maybe at some point we'll add like some kind of REIT ETF or something else in there that gives us exposure to more things, maybe a healthcare ETF, something like that. But that's later on down the road. So we intend to get those positions up. We would like to get SCHD a little bit more slowly over time. So if we accumulated, say, $30 a month worth of GPIC or any of those other positions, we would only want to get like 15 of SCHD because, again, the yield is lower and it costs more money to accumulate more shares because it's a little bit more expensive. And maybe also if the price is right, we could do some cash secured puts to get in. There is that. For something like GPIX, BSTZ, we can just buy that whenever. That's not a big deal. But GPIX, something like that, we want to at least wait until we get like a slight pullback on a daily basis, whether it be like a 1% pullback in the indices or a 2% pullback in the indices. I mean, there's heavy correlation between all four stock indices. So if, say, for instance, the Russell 2000 pulls back, then the S&P is probably also going to pull back. If the NASDAQ pulls back, it's pretty much a guarantee that the S&P is going to pull back. Why? Because a lot of the weightings of stocks and a lot of the stocks that are in the NASDAQ are also in the S&P 500, like the Mag 7, for example. So there's that. So we'll also talk about the holdings. And I remember that I said this a few weeks ago, but I forgot to follow up with y'all as to why we were specifically buying JEPQ and SCHD. Because you guys might be wondering, you were like, well, okay, SCHD makes sense, but why are you buying JEPQ when you have GPIC and also Triple QI? Well, they pretty much they all have similar holdings, just different strategies as to how they do their ETF. But one of the main reasons why we want to have JEPQ specifically is because of the long-term track record that it has. It has a much more lengthy, successful track record than GPIC and Triple QI. But on top of that, in particular, is just for the holdings. I mean, the two main ones that we're looking at here that we want to get exposure to that we do not own directly is Apple Inc. Because, again, everybody has an Apple iPhone, right? Well, most people do. And, they're constantly on their phones using data and all that stuff. We want to take advantage of that. I mean, if people are going to spend their whole day scrolling, we want to profit off of that. Just going to be completely honest about it. It's, trading and investing is what it is. We're here to make money, right? So Apple, Broadcom, those are a couple examples. I heard Tesla's coming out with a phone. If that happens, that'll be pretty sweet. T-Mobile is another good one. That's a service provider. So, a lot of people have T-Mobile. We obviously want to profit off of that. You have other things like Cisco here, Comcast. These are kind of all in the data center cellular service, that kind of stuff. PepsiCo, obviously another big one, right? Everybody drinks. Well, not everybody, but a lot of people drink caffeinated drinks. Monster, Beverage Corporation. These are kind of the ones that we're looking at here. Coca-Cola. There's some others in here that we do want to get exposure to, but those are kind of the main ones. But the fact that this thing is diversified is a good reason to hold it, in my opinion, get broad exposure to the markets without having to buy 200 or 300 separate stocks, right? Because that's a lot more expensive. Plus, this one also has the ability to do options as well. So cash secured puts and covered calls. Some people do that with these, even if they pay dividends. The same is true for SCHD. So the main two reasons why we're getting into SCHD is number one, for this particular stock right here, Altria Group. A lot of dividend investors own this stock. It's known as a SIN stock. Basically, it's a tobacco company, right? A lot of people smoke, and it's kind of a degenerate habit. But the way that we look at it is people make the choices that they make. They're grown adults. They can. If they want to smoke or do whatever they do, they have the right to do that. That's their choice. We just want to make money on it. That's our only primary concern. A lot of people might say it's wrong, but the reality is literally anything can kill you. So it doesn't necessarily have to be this. That's just kind of how we see it. But the other reason is because of the broad exposure to dividend growth stocks, okay? We used to have a lot of these single stocks in our portfolio as single stock positions, but it's just easier to buy the ETF itself and to just have to maintain one position instead of like 50 or 100. So Coca-Cola, Verizon, Cisco, Home Depot, Altria, Lockheed Martin. We used to have all these. Chevron, AbbVie, Amgen, Pepsi, Bristol Myers Squibb. Never had UPS, but that's good. I suppose that it's in there. We had, let's see, we had this one, Kimberly Clark, Target. We also had Hershey's, Archer Daniels, T. Rowe Price, and never had Best Buy. That's a new one. Skyworks Solutions, we had that one at one point in time. And just continuing to go down the list here, I'm not really seeing any others in here. We did have Wendy's at one point in time. There was a, I forget what the name is called, but there's a company that owns like Wendy's and Pizza Hut and stuff like that. Whatever the name of that one was, we used to have that one too, although I can't think of it off the top of my head. So that pretty much covers that in terms of the dividend ETFs. So the swing trades, basically going forward, the goal is the same here. So 4 positions equally split as much as humanly possible. Okay, so if it's $10,000, we put $2,500 into each, with a minimum goal of 15% per trade. If we get 20, 30, 50, 100, 1,000%, whatever the case may be, we'll take it. It's icing on the cake. So the goal is to eventually get to an excess of 30K. Once we get to that point, what we're going to do is we're actually going to, we're not necessarily going to take swing trades at that point on just any particular stock. What we're going to do is we're going to look for more high quality stocks. So that would be any large name stocks. Have good cash flow and stuff like that. They're solid, stable companies. So we'll talk about like what some of those are. So basically you would have things like your Mag 7, Coinbase, MicroStrategy, ARK's probably also a solid one. I don't really see that one going bankrupt anytime soon. Let's see some others. So we may also do things like perhaps maybe even the silver and gold ETF. We could do that too. It's not necessarily a stock, but there is money to be made there. So the much larger companies, right, that can produce at least 15%. And then for the smaller ones, we may still do smaller to medium-sized companies, but they'll be companies that we are pretty confident are going to have a bright future, right? So anything AI, quantum stocks, semiconductors, anything future technology that already has massive cash flow contracts and all that kind of stuff, like APLD, Serve, all these quantum stocks. SoundHound is another good example. American Airlines, Snap. See Affirm, Robinhood, SoFi, just stuff like that. Things that basically kind of move away from the whole penny stock thing. We've traded penny stocks in the past. It's not really a problem. Basically, if it gets delisted, it gets sent over to Pink Sheets, then we have to find a way to sell it. There's that. But, moving over to larger cap stocks with a larger portfolio is kind of a way to also simultaneously protect the portfolio from any stocks possibly going bankrupt, which, again, I highly doubt is going to happen because the Fed is always the buyer of last resort. So now taking a look at the rest of the portfolio here. So again, we're slightly under 5 figures at this point for this piece of the portfolio for the swing trades, but at some point we will be above that 5-digit number, and then we'll want to slowly transition into kind of larger based companies. So that pretty much covers that for the swing trades. And as for TSLL and Soxel, basically Soxel, we do want to own that one, but at the right price. And again, sometimes it makes sense to put on a cash secured put on a green day, but most days it doesn't, because again, when the market is going down, this is a 3x leverage fund, so it goes up and down very, very violently in both directions. It's possible to see easily a 10, 15% move in one day on this particular ETF, Soxel. But when the markets go down, the premiums for cash secured puts generally are better, and you get cheaper prices than if it's going up and you do a cash secured put. So we basically intend to just use that to produce weekly, monthly income. We don't really care per se if it goes to the moon or not. That's kind of the goal here. Whereas TSLL, this is a different story. This is a triple play. So it's a play on options to make some premiums when the price is right. It's also a long-term investment because Tesla has a bright future, in my opinion. And on top of that, this is a longer-term swing trade. Okay, so when I say longer term, I mean as long as it takes until we get to the right price, which needs to be at least double the current price as of right now. Um, so in terms of and again, this kind of backs onto what Tesla is going to be doing in the future. I don't know if they're going to create a phone or not. They might. That'd be pretty cool if they did. I mean, Google has a phone, and then you have the other phone companies like Apple and stuff. So it wouldn't really shock me. But two things that they're planning on doing here soon, based on the news that I've seen about Tesla, and I believe the shareholder meeting and the robotaxi thing is going to happen next month. And there's rumors, I don't know if it's true or not, but they're going to have like a Optimus robot dance crew to put on a show during the investor meetings. So I'm not really sure if that's going to happen or not. We'll see. But this again goes to kind of the extension of Tesla's business to where it goes from being just a car company to now being like a company that produces autonomous vehicles that basically are driving on every road on the planet. And then on top of that, you have the humanoid robots, and God knows how many of those could be created, what they could do, how much profit that could produce for the company, and the market cap that Tesla could reach as a result could easily be like, I would say anywhere between at least 3 to 5 trillion. Wouldn't be surprised. So this is a number based on this article here that says that the robotaxi market is supposed to reach. See, I know I saw the numbers here somewhere. Supposed to reach, oh, here it is, 45 billion or 46 billion by 2030. I will tell you guys right now, I think that's probably undershooting the potential for this market. I could easily see this thing being probably at least 100, maybe 200 billion by 2030. I think 45, 46 billion is a relatively conservative estimate. I mean, you guys have seen how many more Teslas keep getting sold year over year over year. The rate is compounding very fast over time, and I expect the exact same thing to be for these two markets too. And in terms of the global market for humanoid robots, according to Goldman Sachs, or the Goldman Sachs article here, anyways, allegedly, 38 billion by 2035. Again, I think that's relatively small. And according to this graph here, that is the most bullish case, like the absolute mega ultra perma-bull kind of case, like the best case scenario, right? I think this is actually probably even more underestimated than the robo-taxis. And the reason why I say this is because robo-taxis really can only be used for a few things in transportation. I mean, transportation of people, transportation of goods and services, and maybe also like for renting a car out to use it to let people use that they pay you for, right? In case you own one. Kind of like, renting your car out for money or whatever, or using it for like an Uber or something like that. If people were to actually own these robo taxis, they could then rent it out for some kind of income. That's what I'm referring to here. Whereas the Tesla robot could literally do just about anything except for transportation. But who's to say the Tesla robot couldn't eventually become smart enough to actually man one of these, what are they called? One of these robo taxis. That could happen, right? Where they could literally man anything. I mean, if it can do anything a human can do, then, obviously the market for that is going to be much larger, in my opinion. And I could easily see both of these markets individually by themselves becoming at least $1 trillion market by 2035, maybe 2040, if not greater than that. So that pretty much covers the entire portfolio. Now that's the portfolio as of right now. Some of these things may change. I mean, it would definitely be nice to, like, if we got out of TSLL at some point for, say, like a 50K, 60K, 70K profit, to sit back and cash and wait for another, extremely cheap dip buying opportunity to rinse and repeat the same process again to triple the capital, right? We may do something like that in the future as well, but, and I mean, it could work. I mean, get a lot more income and premiums. It kind of just depends on what we want to do, but the dividend ETFs and the leveraged ETFs serve as both or they serve as an income piece, but then the leveraged ETFs and the swing trades serve as a capital grower as well. So we're kind of doubling down and mixing in between the two. So that's pretty much what's going on right now. Anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.